Everybody doesn't want to take all this big old risk that we see with individual stocks. Some people just like to have safe investments that are low risk, but also get them in the game of investing while being protected. Guys, you don't need to risk it all to build wealth. Before you drop another dollar on a risky play, I want you to watch this video first. Now look, wealth building is not about chasing every hot stock or crypto that's out there, right? If you want to grow your money without losing sleep, you need a foundation of low risk investments. Today on this video, I'm going to break it down for you so you have a list of things that you can still invest in and feel safe and maybe sleep better at night. I'm going to give you 10 low risk investments that anybody can start with. Plus, I'm going to give you a bonus at the end. So let's start off with one of everybody's favorites, which is the high yield savings account, right? The HYSA. This is one of the easiest wins out there. It gets you the same FDIC protection as your regular bank account, but it can get you 4.5, sometimes even 4.75, maybe 5% APY right now, which is perfect for an emergency fund or some type of short-term money goals that you may have. Your money stays liquid in a high yield savings account. It's safe, and you can open a high yield savings account in just minutes with banks like Ally, Marcus, SoFi. There's a bunch of them, right? You can get a high yield savings account almost anywhere online. Now, the downside to high yield savings accounts is that many of them won't beat inflation for the long term, but they do offer you a peace of mind. And you also got to keep this in mind about high yield savings accounts. As the Fed funds rate goes down, so does your return on investment in your high yield savings account. Yeah, some might be offering 3.5%, 4.5% right now, but as the Fed funds rate gets lowered, maybe in the next few months or so, you're going to see your returns go down as well. They're variable rate accounts is what they are. Just keep that in mind if you have a high yield savings account. Now, the second one is your certificates of deposits, often known as CDs, right? With a CD, you can lock in a fixed rate, 5%, 4%, 4.5%, 3.5%, or more for a 12-month CD. And you can just lock it in and forget it. They're FDIC insured. They have fairly predictable returns. Just know though, if you break the term of a CD, you pay a penalty for that. Now, CDs are great if you know that you won't touch the money for 6 to 12 months, sometimes longer. Not a bad option for some people. Now, let me say this, right? Some people feel like some of these lower interest paying places to put your money are like bad for you. You shouldn't do it. Don't do it. Listen, I'm not telling you to have all your money in a CD or all your money in a high yield savings account, but there's certainly nothing at all wrong with knowing about them and having a portion of your money in these type of low risk investment accounts. So you see some people that come on the internet, YouTube, Facebook, wherever, Instagram, and they talk down about some of these low risk investments. But guess what? There's a lot of people out here that don't want to take some of the risk that may be involved with individual stocks, right? And that's totally understandable. There's options to invest your money and grow your money at every level of risk on the risk pendulum, okay? So the third one is T-bills and T-bonds. Now that's Treasury bills and Treasury bonds. With Treasury bills and Treasury bonds, you're lending money to the U.S. government, which really is one of the safest bets on the planet. I know it don't feel like it right now, but it really is. Now, T-bills are short term and they can pay anywhere from 4 to 5% right now. Oftentimes they pay lower than that though. And then your T-bonds are your longer term and they're paying somewhere around 4.5% right now. They're safe, they're steady, they're predictable, but if you sell your bonds early, you could lose a little bit of that value. Please keep that in mind. Now, the fourth one is I-bonds. Now, I-bonds are just government savings bonds that adjust for inflation every 6 months. Currently, I believe they're around 4% or so. They're supposed to be, that's why they call them I-bonds, because they're inflation bonds, right? And you can only buy $10,000 per person per year in an I-bond. And you've got to hold the I-bond for at least 12 months. Now, when inflation was really high just a few years back, I-bonds were a wonderful investment because, again, they adjust and pay according to what inflation is. And they acted as a wonderful hedge against inflation. If you know anybody that picked up an I-bond when inflation was really high, let me know in the comments below. Now, the fifth low-risk investment anyone can start is a money market account. Now, think of a money market account as a savings account with a little more flexibility, okay? Currently, you can get a money market account anywhere from 3 to 4.5% right now. They're safe, they're liquid, and they're FDIC insured as well. And they're perfect for if you need money in the next few months or so, right? You need money soon, 6 months, 5 months. Money market accounts are a great place to park some money, maybe even park your emergency fund. Now, number 6 is low risk investment, gold and silver. Now, sometimes I look at gold and silver as insurance more so than I look at it as an investment, but some people use it as an investment, and that's fine. It's not income producing, right? These precious metals, they don't produce any income, but they're a powerful hedge against inflation and a powerful hedge against any currency issues. People always talk about right now how the dollar is getting weaker and weaker, right? The dollar's getting weaker and weaker. Why not pick up a little bit of precious metals to have in your portfolio? I'm not telling you to go make 90% of your portfolio gold and 5% silver. No, I'm not saying that. But having a little bit of gold and silver or precious metals in your portfolio, nothing wrong with it. You can even get them in ETFs like GLD and SLV, which are easy to buy gold ETFs. Or you can go physical gold with coins and bars and all that, right? Maybe a small allocation of your overall portfolio, 5 to 10%, is nice to have in precious metal for some type of long-term insurance. Think about it. Guys, if you're getting anything out of this video, do me a favor and smash that like button below. Also, please share this video with your friends, your family, and your network of people. And if you're not a subscriber to this channel, please consider subscribing to my channel. Now, let's get back to the video. Now, number 7 is broad market index funds and broad market ETFs. Now, why do I say they're low risk? One, they're low cost, right? Not only are they low cost, but they're very diversified. Index funds and ETFs are a bucket full of stocks, 80 stocks, 150 stocks, 500 stocks, 3,000 stocks, all in a bucket. So there's a lot of diversification when you purchase a broad-based index fund or a broad-based ETF. And they've been proven over decades to give solid returns, right? We're talking VTI, SCHB, SCHD, VYM, VOO. The list can go on and on of solid broad-based index funds and broad-based ETFs. These typically track either a sector, or they track the entire stock market, or they track the S&P 500, right? Yes, the market moves. We know that, right? But over decades and decades and decades, you're looking at 7 to 10% or more of annual growth. That's solid right there. And fairly low risk because of the diversification that they offer. Now, number 8, the 8th low risk investment anyone can start is REITs. Real estate investment trust. Now, you want real estate cash flow without being a landlord that has to turn wrenches and get phone calls at 2 o'clock in the morning? Cool. Maybe you need to go ahead and look at things like VNQ, which is one that I've actually invested in myself over at Vanguard, right? You also have realty income, you have public storage, PSA. These all pay steady dividends of a little over 3% or more, plus potential price growth along with the real estate market. Now, they can also dip. When you see interest rates rise in the real estate market, you can see returns fall in the real estate sector or REITs, but they're a solid income play over the long haul, and they're low risk. Now, number 9 is fixed annuities. Now, fixed annuities are just an insurance contract that guarantees a fixed return of anywhere from 3.5% to 4.5% to 5.5%. Now, there's no real market exposure with these. They have pretty much predictable income, but at the same time, your money's locked up. These fixed annuities are best for people that want retirement income or people who value certainty. They value locking in a certain fixed amount of money every single month coming to them, right? Over the flexibility or the extra risk that comes with that flexibility. So if you like certainty, you want to consider annuities. Now, the 10th one is dividend stocks. Stocks that pay a dividend to its shareholders, right? Companies like Johnson & Johnson, Coca-Cola, ticker symbol KO, or ETFs like some of the ones I mentioned earlier, SCHD or VYM. All of these pay you to own them. They pay you a certain yield, a certain return just for owning them, right? Could be a 2% yield, could be a 3 or 4 or 5% yield. So not only do you get dividends, but you also get the growth in the share price, right? You still hold on to the shares, right? So you're still tied to the market, but you're getting good long-term income and long-term growth with these dividend-paying stocks and dividend-paying ETFs and index funds. Now, I told you I had a bonus, so here's the bonus. The bonus is preferred stocks. Preferred stocks are kind of a hybrid between stocks and bonds. Preferred stocks offer fixed dividends, which are usually around 5% or could be better than 5% sometimes. But preferred stocks are also less volatile than regular stocks. But they also have limited upside as well. So preferred stocks are really good for people that want a steady income, right? So I just wanted to throw in preferred stocks because a lot of people oftentimes, we look at common stock that we get off of the regular stock exchange that we're always looking at all the time on the internet, right? People forget about the fact that you can own and purchase preferred stocks too. So the bottom line is this, guys. Low risk investing isn't about getting rich overnight. It's about keeping your money constantly working for you and compounding for you, at the same time keeping you protected. Because everybody doesn't want to take all this big old risk that we see with individual stocks, or sometimes that we see in some of these other areas. Some people just like to have safe investments that are low risk, but also get them in the game of investing while being protected. So you need to pick the option that fits you the best. Look at your timeline when you want to use the money. Look at your risk tolerance level, right? Are you a person that wants to take a lot of risk? Or are you a person that hates risk, right? And look at what your overall short-term and long-term money goals are to see if any of these low-risk investments fit you and help you literally sleep better at night, knowing that your money is not out there being gambled away, but it's out there safe. But always remember this, when you have low risk investments, you also limit your upside. A CD and a money market and a high yield savings, they're not going to give you a 20% return, but they're also not going to give you a 20% loss. So hey, if you got value from this quick video, do me a favor, smash that like button for me. Share this video with someone who you know needs maybe a low stress money plan or a low stress place to park some money, short term or long term. Hey, as I always say, the best person who's going to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.